Um, so today's format, as you may have known when you registered, we asked you to submit questions beforehand so that we could do a little bit to prepare and make sure that we're addressing as many questions as possible. So the way that we're going to format this is we're going to kind of go through different areas as it relates to the PPP loan and do a little bit of question and answering based on the questions that were submitted beforehand. Hopefully we'll get through those in the first 40 minutes or so, and then we're going to leave the last 15, 20 minutes open for questions that you're submitting throughout the course of the presentation. And hopefully we can address all of those. Obviously, there's a lot of information to go through, but we're going to go through it as best we can in the time that we have. So please make sure you're submitting your questions through the Q&A so that if we don't get to them, we make sure to get back to you after. So we do just want to start off by reminding everybody that information continues to be clarified. Every day information is changing. If you've seen, if you've been paying close attention to the guidance that's been coming out from the SBA and the Treasury, you'll know that we've seen probably upwards of 6 or 7 interim final regulations on different aspects as it relates to the PPP loan. So there is always the possibility that something that we talk about today is going to change later today or tomorrow or next week or in a month. We are doing our best to interpret the information as it comes out and pass that on to you. But just know that the guidance that we provide today, some of it may potentially change down the road. So we're not providing legal advice. If you do have a legal question, we advise that you talk to a lawyer, and we are just offering general ideas and considerations. But obviously every organization that's on this call has a different situation. So we're not able to address those specific situations, but we're going to do our best to advise as it relates to the general population and specifically on this call as it relates to nonprofits. So with that, we're going to go ahead and jump into some questions. Melody, if you want to go ahead and fire off some of the first questions. What I've got on the slide here is just a list of the eligible costs. We're going to talk a bit more in detail about this, but I wanted to make sure that everybody had a good understanding of what the payroll costs and non-payroll costs were. So Melody, take it away.
Can you look at your slide? Because right now we're still seeing the initial slide.
Let's see.
Okay. And we were going to start off with period.
Sure, let's go to covered period.
So how long do we have to spend the funds, and when does that clock start?
Absolutely. So as you may have seen, there is what's called a covered period as it relates to the PPP loan. That covered period is an 8-week period that funds can be used over to be eligible for forgiveness. That 8-week period begins, as it stands right now, the day that funds are dispersed into your account. So you cannot choose the day that the funds are dispersed into your account, and you cannot choose the 8-week period that's covered. It is defined as the 8-week period that starts the day that the funds are dispersed into your account. When you're approved for a loan, the lender has 10 days to disperse the funds to you. So there is potential that if you were approved and you wait a little bit to accept the loan, you could potentially push out that disbursement date, but that's not an all-inclusive scenario, since the lender could potentially disperse funds to you the day after the loan is approved or within that 10 days. So there truly is no way for you to be able to define the 8-week period that's covered. It starts the day that the funds are dispersed into your account.
Great. So the big questions have been about what are the eligible payroll costs?
Yep, absolutely. So as I listed on this slide here, which will be sent to you after the presentation as well, the payroll costs are defined as the gross salary, which includes wages, commissions, or tips, and that is capped at a $100,000 annualized basis per employee. So that does not include the benefits that you pay to the employees. It is strictly the gross salary. It also includes benefits such as vacation, parental, family, medical, or sick leave, This is sick leave that is not covered by the Families First Coronavirus Response Act. So if it's sick leave that is unrelated to COVID-19, caring for somebody that has COVID-19, or as it relates to the lack of health care due to COVID-19, that sick leave would be eligible under the PPP loan. Let's say somebody's out sick with a cold or allergies or taking a mental health day. That sort of sick leave is covered under the PPP eligible costs, but anything again that's related to COVID-19 and falls under the FFCRA, that is not covered by the PPP funds. In addition, severance pay is covered. So if you are required to continue paying somebody severance pay, that can be covered under as an eligible payroll cost. Employer payments for the provisions of group health care benefits, which we'll talk a little bit more about later, but we'll leave it at that for now. The employer contributions to retirement plans, the employer paid state and local taxes. So for most folks, that's probably going to be any state and local unemployment tax, any employer paid state or local if there's some sort of family leave tax. I know Washington, D.C. has a D.C. family, I believe it's like the family paid leave tax. So things like that would be covered. And then for non-payroll costs, you can include rent, utilities, which I've defined here as gas, electric, water, transportation, internet, and phone, and interest on mortgage obligations. So that utilities, the one question I have seen a couple of times is, what does transportation mean? That's a very good question to ask. We don't have quite full guidance on that. Some have interpreted it as fuel. So if you're paying somebody mileage, we have some for-profit clients that fill tankers with fuel, and it does appear to be covered for that, but that one's a little bit of a question mark. For sure that are covered are the gas, electric, water, internet, and phone. And then as it relates to interest on mortgage obligations, there was a question relating to real estate or personal property. Right now, I would advise that it could be both. For sure, it is interest on real estate. So if you own a building and you have a mortgage payment, the interest on that mortgage payment for your building is absolutely covered as a non-payroll cost. For any other debt obligations that you have, there is potential that the interest on those could be included in the non-payroll costs. But unfortunately, at this time, we just don't have final guidance on that piece. But just make sure to keep track of it if it is able to be covered.
And Kate, just going to jump in quick. Your slides still haven't switched yet. Do you mind just ending your
Sure.
screen share and try it again?
Absolutely.
To let everybody know, we will be sending out these slides afterwards. So don't need to worry about writing things down. We'll have this information, and we'll also be sending out this recording. So don't worry about that. We'll try to get this up and running.
Is it on the eligible costs page?
That is perfect. Thank you so much, Kate.
Okay. And can you tell me if it changes when I do this?
Yes, we are all
Awesome.
good.
Okay.
Thank you,
Sorry
everyone.
about that, guys. Yep.
One of the questions, Kate, that's coming in the chat is regarding utilities. Can you reimburse for workers at home their utilities?
That is a great question. Obviously, a lot of people right now that are working remotely probably weren't working remotely before. So as an employer, you may be interested in keeping them on, and in doing so may want to be paying for some phone or internet costs for them. At this time, there is not guidance on whether or not that's going to be covered. Again, if you do choose to cover that, I would recommend just keeping very good documentation. If you are going to pay for an employee's phone usage or internet usage, you are going to want to make sure that they provide you with a receipt for their internet utility bill or their phone utility bill, if it does end up that it is able to be covered. Unfortunately, you're going to hear me say this a lot over the course of this presentation. Just at this time, we don't have final guidance on the use of or the forgiveness, which seems crazy at this point, since I know most of you probably already have your funds and want to be able to use them. But as of right now at 10:12 a.m. Central Time, the final guidance has not been released on the use of or forgiveness of these funds. So the information that we're giving out today and our answers to these questions are based on the guidance that is available at this time. and interpretation of them. So.
Awesome. So what about the employee salaries when they're over 100K? Does that apply to retirement benefit as well?
Good question. So again, that gross salary, the $100,000 cap is just on the salary itself. It does not include retirement or healthcare benefits. So any payments that you make on behalf of an employee for healthcare benefits or retirement plans is in addition to that $100,000 cap.
Awesome. So what about, there's an organization that has seasonal or temporary employees hired for specific activities during different times of the year. Some of those seasonal or temporary employees will be paid during the 8-week period. Are they able to include those costs in the calculation of the forgivable amount?
Absolutely. Those would be eligible payroll costs. Anybody that you pay on salary over the course of that 8-week period, you would be able to, those would be includable as eligible payroll costs.
One of the ongoing confusing questions that has conflicting information out there is the exclusion of payroll withholding. In terms of withheld payroll taxes, is it gross or net?
Another great question, because that has gone back and forth. So it is gross salary that's included as an eligible cost. So the only employer paid taxes that are not included as eligible costs are the employer's share of Social Security and Medicare, also known as FICA taxes. So the employee's share of Social Security and Medicare is included in that gross salary amount, in addition to the amount that you withhold for federal and state on the employee's behalf. That is included because you can include your gross salary as an eligible cost.
Awesome. Now, another question comes up with bonuses or different ways of accounting extra pay or increasing pay during this time based on maybe not working the full hours. What can they do in terms of bonuses or pay adjustments?
So I'm unfortunately going to have to say it again that we are still waiting on clear guidance. However, there isn't clear guidance on bonuses or prepayments or back pay at this time. The best interpretation that we can provide is that providing employees bonuses to get them back up within that if you reduce salaries and you want to get them back up to within 25% of their wage before you reduce their salary, utilizing bonuses is likely not going to be a valid way to do it because the forgiveness is based on the funds used to cover an 8-week period. A bonus that you provide to your employees in that 8-week covered period that you wouldn't normally pay to them, and if their salary goes back to what it was at the reduced amount after that 8-week period, you're going to have a hard time justifying that you actually did increase their salary back to that original amount. So I would advise against using bonuses as it stands right now to bring people's pay back up. The reality is that you're likely going to have to actually bring either it's their hourly wage or if they're salaried, you're going to have to bring them back up to within 25% of what their hourly rate or their salary was as of 2/29 of this year.
Do you include hazard pay in those bonuses?
So there's mixed guidance on hazard pay. I think most of the guidance that we've seen does include hazard pay as eligible costs for the under the PPP. At this point, since there are probably a lot of people that are requesting people to work in a time where employees may be not comfortable going into work, there has to be something that that encourages them to come back to work, and hazard pay would be one of those items. At this point, there isn't anything that has defined whether or not hazard pay is specifically includable as an eligible cost, but it looks as though the likelihood is that it will be included because hazard pay is such a hot topic right now.
It certainly appears reasonable. How about for 1099 contractor payments and or if we use a PEO, how do we treat those?
Sure. So those are two different situations. So for 1099 contractors, those costs are not eligible uses of the PPP funds. The only eligible costs are payroll costs that you pay to employees on a payroll. So these are people that get a W-2 from you at the end of the year. If you pay somebody and they receive a 1099 from you at the end of the year, those are not eligible payroll costs, and you cannot use the PPP funds to pay those people. As it relates to a PEO, we have many clients and organizations that use a PEO. So that is a valid payroll cost. What you'll want to make sure that you do is that you've contacted your PEO, you've let them know that you applied for and or you received the PPP funds, and you're going to need to receive from your PEO specific documentation on your payroll as it relates to your organization. So the likelihood is that you may already be getting some sort of payroll invoice or register from your PEO. What you'll want to make sure is that it comes to you with a bit more detail. So if there's a lump sum amount for health insurance contributions, you'll need to make sure that that's broken out between the different types of health or fringe benefits that you're receiving. You'll also want to make sure that if people are being paid under the Families First Coronavirus Response Act, that information is broken out. So you're just going to need a little bit more detail than you might usually get from your PEO. At this point, my guess is that most PEOs have some sort of system in place to be able to provide their clients with the appropriate level of information. So just make sure that you're in contact with them and reaching out.
Kate, do you mind defining what PEO is for some of our attendees?
Sure. PEO is, what does it stand for? That's a great question. I'm just saying PEO. So typically it's somebody else.
Is it professional employment?
There we go. Professional employment. What was the last word, Melody?
Organization, maybe. I'm not sure
yeah.
what the O is.
Okay, thank you.
So essentially it's another organization that you pay to maintain your payroll. So a PEO is going to file employment taxes for you, and they're going to file it under their employer identification number. So essentially the payroll is actually run under the PEO's name and employer identification number. They file a Schedule 941, which is a quarterly employer tax form, but they file it under the PEO's name as opposed to filing it under the individual organization's name. So if you go to, let's say, Paychex and they process your payroll, they're going to file the quarterly reports and the year-end reports under your organization's name and employer identification number. A PEO essentially takes on that obligation for you. And they do some consolidated reporting under their name and their employer identification number, but they have the ability to break out information for your specific organization. So,
perfect. Thank you both.
If an employer has a bundled benefit package that includes health, disability, retiree, and basic group and life, can they include all of those as eligible expenses?
So again, this is another item that hasn't been clearly defined yet. The statute itself, or the Treasury's fact sheet, states employee benefits include payments required for the provisions of group, including insurance premiums. Now, from my reading, from my background, I would take that as any type of group healthcare benefits. I would include medical and dental and vision, maybe a health savings account. However, we have done a lot of reading that says the only thing that could be potentially covered is a group medical plan. So if you use, GHC or Blue Cross Blue Shield, the only thing that you are going to be able to use these funds for potentially is the cost of that actual group medical coverage. And dental and vision, HSA plan or health reimbursement plans may not be covered. We did receive guidelines. If you're in the state of Wisconsin, I'm sure we have people from all over, but since we are based in Wisconsin, I'm going to reference a guideline that was sent out by the Wisconsin Bankers Association to the bankers here in Wisconsin. Their guidelines state that they don't believe that dental insurance is covered. So again, another item that's going to be up for interpretation and will hopefully be, the guidance will hopefully be rolled out here. It was supposed to be rolled out earlier this week, but we're still waiting. But they are going to have to define exactly what group healthcare benefits means. Again, at this point, I just say document, document, document. So make sure that you keep any sort of invoice that you have, any record of payment for anything that you may define as group healthcare benefits. And once the final guidance is rolled out, you're going to have that backup documentation to be able to provide to your lender when the time comes, whether it is or isn't covered.
Awesome. So now as I'm looking through the chat, this segues perfectly into what we are going to talk about next as expenses based on cash or accrued. And what does this mean?
Yes, big question. So another very loaded question. Again, the guidance states that the 8-week covered period is intended to cover costs incurred and paid in the 8-week period. Now, that leads us to a whole litany of other questions because costs incurred versus costs paid mean two different things when you're coming at it from an accounting perspective. Incurred, you would think accrual basis. Paid, you'd think cash basis. So how do we interpret this? What does it mean? At this point in time, what I would advise is that clients utilize a mostly cash basis methodology. What I mean by mostly cash basis, for instance, I'm going to refer to eligible payroll costs because it should be the biggest portion of what you use these funds for. What we've been advising clients is that eligible payroll costs would be based on the payroll check date. So not on the payroll period date. So it doesn't matter when the payroll period began or ended. It matters when you paid the payroll. So if you received your PPP funding yesterday, April 30th, and you have a paycheck date of today, and the money comes out of your bank account today, then you would include that payroll, the costs related to the payroll that came out of your bank today in the covered period. This way you don't have to be manipulating the first payroll and the last payroll and reconciling between the two. Our best advice is that it relates to the costs that actually happened in this 8-week period. For non-payroll costs, the assumption is that the 8-week period should pretty reasonably cover 2 months worth of the rent and the interest and the utilities. As it relates to prorating for the 8 weeks versus actually 2 months, another item that we don't have clear guidance on, but if we go with the mostly cash basis methodology, we would assume that you're going to be able to include 2 months worth of rent, 2 months worth of utilities, or potentially 2 months worth of interest on your debt obligations in the covered costs. Again, just make sure that you're keeping supporting documentation for everything.
Awesome. So prepaid, you're saying we generally can't do that. Is that correct?
That is what we would advise. I have seen guidance that says
paying expenses in advance.
Sure. So at this point, you can certainly continue to pay expenses in advance if you have the cash, but that doesn't necessarily mean that you're going to be able to use those funds to cover use the PPP funds to cover the entirety of the prepayment. There is very specific guidance as it relates to prepayment on the mortgage obligations that it does not cover. The PPP funds cannot cover any prepayment on the interest on the mortgage obligations. So I would apply that to all of the other eligible costs as well, that prepayments are not eligible covered costs. Again, this kind of goes back to that incurred versus paid. What happens if you've paid for your group health insurance premiums in January and you paid 6 months ahead? Now what do you do? Because you're not going to see actual cash expenses for 2 months or 8 weeks worth of the covered period. That's a situation where we kind of have to go back to the mostly cash basis method. Since the group health insurance coverage is an eligible payroll cost, we are going to relate those eligible payroll costs back to the date that the payroll was paid. So you're going to be able to take whatever portion of the employer paid portion that relates to the payroll that you paid in that 8-week period. So do we want to call it modified accrual or mostly cash basis? it's really still up for interpretation. And we know that the final guidance will have to address this because obviously as accountants working with our clients, this is probably one of the most common questions that we've seen. But at this point, in terms of documentation, keeping records, ease of tracking, our best interpretation is that you would be on a mostly cash basis as it relates to the eligible payroll costs and the non-payroll costs.
What about if I have utilities on a budget plan? How do I do that one?
Sure. So ideally, you're going to have supporting documentation for any payment that you're considering an eligible cost. So if you receive a bill and you're on a budget and that bill shows the budget amount that's due, the likelihood is that's going to be the amount that you can pay. If you're able to talk to your utility provider because you know that your utility costs are going to go up in the months that this 8-week period is going to cover, you're going to need to provide some sort of supporting documentation that matches the amount that you actually paid. Otherwise, you're going to have a hard time when you go to provide supporting documentation to the bankers when it comes to forgiveness as to why the amount that you paid that's more than the bill you received should be covered. So it's, a lot of this is going to be talking with your providers, making sure that you have receipts or invoices that match the amount that you're paying.
Awesome. Now, another question came in related to what we were talking about earlier with wages. Housing allowance for ministry.
Yep. So that is an eligible payroll cost. That actually was final guidance that came out within this week, I think. So housing stipends and housing allowances are eligible payroll costs, and they are included in the gross salary amounts. So they are not on top of the $100,000. They're included in that $100,000 cap as a gross salary amount, but they are eligible payroll costs.
Another question came in about the bonuses we were talking about earlier. What if you regularly have paid bonuses during that 8-week period? Does that change it?
I think that it's going to you're probably going to have to justify if that's something that you regularly do. For instance, we have some for-profit clients that may work on commissions or, selling bonuses, and maybe this 8-week period, they aren't seeing a large drop in sales or potential for commissions. There's going to be, some sort of basis that the bankers are going to have to be able to look back and say, this was a normal cost that you incurred. So if you're providing regular bonuses on a regular basis, either pre-pandemic or post-pandemic or during the pandemic, there is probably a much stronger likelihood that those are valid eligible costs.
Looping back a little bit to the payroll on two other points that just want to clarify because questions are coming in about state and federal unemployment.
Sure. So the state and federal unemployment that an employer pays. So for most organizations, most states, there's going to be an unemployment tax that is employer only paid. In Wisconsin, we have a state unemployment tax that the employer is responsible for. Those are eligible costs under the payroll, under the eligible payroll costs. The only taxes that are not covered by the PPP funds are the employer's portion of Social Security and Medicare. So there is a 7.65% tax between those two items that the employer is responsible for paying on each employee's wages. The PPP funds do not cover that piece and that piece only. Essentially, everything else that an employer pays and the employee is responsible for is all covered as eligible payroll costs.
Awesome. So that segues really well into next question is coming up here in the chat and going to how do we calculate the FTEs?
So FTEs have been a huge question because you probably in the normal course of operations didn't really think about FTEs too much. You've got some part-time employees, you've got some seasonal, some temporary, and then you just have your full-time salaried people. Well, with the PPP loan, a lot of focus is going to be put on the full-time equivalent. So FTE is a full-time equivalent employee. The full-time equivalents are typically defined as somebody that works 40 hours a week. That would be somebody that's a full-time equivalent. There has been some questions about what guidelines we're going to use for full-time equivalents, because as it stands right now, the CARES Act did not define what an FTE will be when it comes to calculating loan forgiveness. However, a lot of the loan forgiveness is based on maintaining FTE counts. So it's unfortunate that they didn't make sure that they addressed that from the start. So while we await clear guidance on this, what we can do is interpret other parts of the CARES Act and how it relates to the PPP loan. So in the, there are a couple of other credits that are available in the CARES Act. One is the employee retention credit, which we aren't going to be talking about on this call, but if you do have questions about it, please reach out to your contact here at Wegner or your accountant. But in the employee retention credit portion of the CARES Act, there was a specific reference to Internal Revenue Code section 4980H, which is meaningless in its name, but has some meaning in its definition. So an FTE is an individual who works an average of at least 30 hours per week. So in that case, you're going to have probably even those that you may have reduced down to maybe 4 days a week. You have those people that are still potentially going to be considered at full one FTE. If you have people that work less than an average of 30 hours per week, an FTE is determined by adding the hours of part-time employees. So if you have 20 part-time employees, they each work 20 hours a week. You're going to add up those hours that they work in a month, and you're going to divide it by 120, which again goes back to that 40 hours or 30 hours a week, average of 30 hours a week. And then you're going to get your number of FTEs. So your people that work 30 hours or more, they count as one full-time equivalent employee. So those are easy. But those people that are seasonal, temporary, part-time, you're going to have to look at that 8-week period and the other periods that we talk about, and you're going to need to do this calculation where you actually add up the hours that they worked, which again should be available on a payroll report if they're working on an hourly basis. And then you're going to take that in a month and divide it by 120, and that's going to give you the additional number of FTEs as it relates to your non-actual full-time employees.
Is there any way to factor into this calculation if people are leaving on their own, if it's not a furlough, if they're choosing to leave?
So unfortunately at this time, it appears that it's not going to matter if you have people that make their own decision to leave. There are specific periods of time that, as it stands at this time, the loan forgiveness is going to be looking at specific periods of time that you calculate your average FTEs. Those periods are February 15th through June 30th of 2019, January 1st through February 29th of 2020, the average of whatever your 8-week covered period is for that you can use the loan, and then the FTE number at 6/30 of this year. So that's a lot of different numbers that you're going to have to calculate, but all of those are going to go into how much of your loan can be forgiven, which I can talk about a little bit more as the potential calculation.
We have a choice in which time frame we use, and if we don't get them all back right up till 6/30, does the 6/30 count then?
So those are more great questions. So we have seen that a number of banks have actually released their own version of a loan forgiveness calculator to be able to give you a general idea of what loan forgiveness may look like. Now, because the banks are in the same spot as, working without final guidance, they are doing their best just as we are. But a lot of banks have provided this calculator to their borrowers so that they can at least have a general idea of how it might look. In terms of the full-time equivalent numbers that you can choose from, so those periods that I defined are at this time set in stone. So there is the period February 15th through June 30th of 2019. You'll need to calculate the average FTEs in that period. And they're going to take the lesser of that FTE number versus your average FTEs for the first 2 months of this year. So essentially they're doing that for your organization's benefit, knowing that the period of February 15th through June 30th of last year may not be entirely representative of what your organization looked like at the beginning of this year. So they're having you look at both of those periods to say which one has less FTEs, and we're going to use the lesser of those two numbers. So that's to your benefit. But then they're also going to look at the average FTEs that you employed over the 8-week period. So if you don't hire everybody back until the last week of your 8-week covered period, the likelihood is that your average number is not going to match up to the lesser of the first two numbers that we talked about. So you want to be thinking about that if you are really using these funds to rehire or retain your employees, you want to make sure that you actually rehire them as soon as you can, because that clock starts ticking the day that you get the funds dispersed.
Awesome, thank you.
Yeah.
I want to skip back again to the incurred paid. Have an example here where they pay to, the church pays to the diocese for health insurance and retirement on an annual basis. Should they, to make sure that it's a paid, pay 2/12 of that during this period?
If they have already prepaid it or if they haven't paid it yet.
It's not clear in here whether it's prepaid or not, but to get that actual expense and payment out.
If they haven't paid it yet, I would recommend going ahead and paying it in the course of that 8 weeks. If you have already paid it, we're going to go back to that mostly cash basis as it relates to the payroll costs. So the payroll costs, which include the health insurance and the retirement benefits, are going to be essentially, we're going to call them incurred on the day that you pay the payroll. So anything that actually doesn't come out of the bank, because your gross salary isn't what's going to come out of the bank, it's your net payroll. And you may see tax payments come out at different points depending on when they're due. So we're going to look at that gross salary amount and the payroll taxes that happened as it relates to that payroll are all going to be, same goes with the retirement contributions and the health insurance. It's going to relate to that paycheck date. So I would go ahead and say if you already paid it, you're still going to be able to count the 8-week or 2-month period. If you haven't paid it yet, you can go ahead and use the funds to pay for it because you haven't expended those funds yet. So you're going to want to make the payments in that 8-week period.
Awesome. Another question came in here related to the FTE. Is it true that you cannot include the hours worked by a FFCRA reimbursed employee?
Yes, that's correct.
Awesome. Then can you walk us through a little bit regarding the 25% change in wages? There was a situation that was sent in early on. They received their funds April 17th. They have a season that ends May 15th, which is consistent with prior years. And that means about 20 of their employees usually don't work, and we'll see a 25% or more decrease in wages before the 8-week period is up. Do we have any leeway, or do they have to pay at least 75% of their normal for an extra month?
At this point, the guidance would state that there isn't going to be any leeway. They are going to look at numbers as of the dates that they've identified. So even if your normal course of business is such that your employees back off as of May 15th, but that's still in your 8-week period, it doesn't look like they are going to make exceptions for different types of industries or different organizations. When the final guidance comes out, they may address specific situations like that, or you may be able to talk with your lender. However, at this point, I would say similar to the FTE question about people that left by their own decision, all of those things are going to factor into the potential forgiveness. So if you do back off wages as you would normally do, you're going to end up likely seeing a reduction in the loan forgiveness.
Great, thank you. So an important part of this is you've been saying document, document, document. Yeah. So what's the best way to record the receipt of the funds and account for these? Absolutely. So in terms of specific accounting entries,
when you receive the funds, you're going to receive it similar to any other loan that you've received. You're going to have cash in the bank and you're going to have a loan payable on your books. As you make payments, as you expend the money, you're going to have expenses on your books and you're going to have cash out of the bank. If it comes to the loan forgiveness portion and all or some of the loan has been forgiven, whatever portion of the loan that has been forgiven is going to reduce your loan payable and be booked as income. Now, for nonprofits and for all organizations, the loan forgiveness income is not taxable. However, if you are operating as a nonprofit, but maybe you have a for-profit entity that you also work with, guidance did actually just come out last night to note that the expenses that you covered using the forgivable portion of the loan funds, those expenses will also be not deductible for tax purposes. So we're not going to go into too much detail on this call about that, since our assumption is we're talking to mostly not-for-profit entities, and so that's not going to really factor in. But that is something that you should know if you are working with a for-profit entity as well. But in terms of tracking, we had a lot of questions about separate bank accounts. It's not vital that you use a separate bank account. However, that is the best practice that we have been recommending to anybody that we talk with. There are a few reasons why we recommend this as a best practice. Number one, these funds truly are for very specific purposes. You signed, when you applied for this loan, you certified that you were only going to be using them for the eligible costs. If you use them for ineligible costs, you are actually opening yourself up to a fraud investigation from the government. So you want to be very careful and very specific about how you use these funds. Putting them into a separate bank account is going to help you track, because you're going to be able to essentially use it as a clearing account. And what do I mean by that? So when you use something as a clearing account, it's kind of like a holding account. And you don't pay anything out of that account. You can if you want, but what I would advise is that you set up this separate account that holds the money. And for instance, let's say you have a payroll coming up today that you're going to pay and you've received your money. The gross payroll is $100,000. But what's going to come out of your bank account is maybe $70,000. That's the net payroll. But you know that you can cover $100,000 of that cost with your PPP funds. So you're going to have a payroll register, a payroll invoice that shows you the gross salary, and it also shows you the state unemployment taxes. So you can tie out the gross salary and the state unemployment taxes to the amount that you can now transfer from your PPP holding account to your main operating account. So it's not going to tie exactly to what comes out of your bank account on that paycheck date. So this is just, it makes it easier for you to say, okay, when I transferred money from my PPP holding account to my operating account, I have a payroll register, a payroll report, a payroll invoice that matches exactly to the amount that I transferred from my PPP holding account to my operating account. The same for your rent and your utility payments. You're going to transfer, if your rent is $5,000 a month, you'll transfer $5,000 from your PPP account to your operating account, and you'll have an invoice from your landlord that states rent for the month of May is $5,000, and you're going to be able to track that payment. So that's the reason that we have been advising clients to open up a separate bank account. This way, if you have the funds to cover the amount already in your operating account, it's not vital that you necessarily transfer the money before that expense actually happens. But you're going to want to make sure that you transfer that amount close to the time so that you have a tracking of this payroll goes to this amount that I transferred.
Can I put that, if I have a separate bank account, can I have it in another bank? And can that account earn interest?
So there isn't anything at this point to say that you can't earn interest on it if you put it in another account. What I would highly advise is that you read your loan documents from your specific bank very closely. The SBA and the Treasury did not put out any guidance that stated that you have to leave the money in the bank that lent you the money. So we have a number of clients that work with multiple banks. They received the money from one bank, but their operating account is in another bank. So they moved it to another account in their other bank. Again, you'll want to check your loan documents to ensure that there isn't anything in there that stipulates that you have to keep the money at their bank. We have seen a number of clients that got a little bit of pushback from their bankers about opening up a separate account. If that is the case and you have a relationship with another bank that will open up an account for you, as it stands, again, outside of your particular loan documents from your bank, you should be able to transfer that money into a different account at a different bank.
So as the loan is forgiven, should that be recognized over the period of forgiveness or all in one amount at the end of the forgiveness period?
I'm sorry, Melody, you cut out a little bit, so I didn't catch that whole question.
In regards to after the loan is forgiven, should I be accruing that forgiveness all along, or should it all happen in terms of an accounting entry at one point in time?
Since you don't know what amount is going to be forgiven, you won't really know until you actually do the calculation at the end of that period, which for most people right now, as it stands, is going to be that 6/30/2020. There really isn't a way for you to accrue the forgivable portion. Now, if you are a May 31st year end or an April 30th year end and you got the money before, you're going to want to talk to your accountant if you have an audit or a review to talk about how you're going to need to account for the potential income that you may have received in the current year as it relates to the forgiveness. But the likelihood is that since the calculation can't be done until your 8-week period is over and really until that June 30th period hits, there isn't going to be a way to know how much of your loan is going to be forgiven. Plus, guidance may come out that changes the forgiveness calculation. So I would say at this point, there really isn't a way for you to be able to accrue for the forgivable portion.
Terrific. Now you've been alluding again to documentation, but can you re-summarize what you think the best documentation is for forgiveness? And
Absolutely.
if there's an actual forgiveness form that has to be completed?
Sure. So at this point, you should have maybe received something from your bank about expected documentation that they will need. Our best advice is to keep more documentation than less. So document, document, document has been our motto. The more the better to ensure that you have everything you need when it comes time to present that to the banker. And you will present it to your lender. It doesn't go to the SBA. It doesn't go to the IRS. This will be information that you present to your lender upon the end of the 8-week period or the 6/30 date that they will use to substantiate the cost that you use the funding for. At this point, best advice would be payroll reports and registers. So you're going to need detailed ones that show it by employee because they're going to be looking at, again, your full-time equivalents and also to ensure that you've restored the wages up to within 25% of the normal level for your employees. You're going to need invoices for your health insurance premiums, reports from your retirement plan provider showing the contributions. Those may also be on your payroll reports. So make sure that when you're looking at your payroll reports, if you do have detailed reports that show the employer portion contribution to health insurance, it shows the employer retirement contributions. Those should also work as well, but I would also have invoices from those providers. Rent, utility, and mortgage debt invoices. Potentially you may need receipts showing that you actually paid them. So have the invoice, but if you can from those vendors, get receipt of payment. We've also seen requests for 941s. Excuse me, you'll probably need them for the first quarter and the second quarter of 2020, in addition to quarterly state unemployment reports, again, for March 31st and June 30th. And then, yeah, again, just the detailed payroll registers are going to be very important. So again, the more documentation you have, the better. I would advise, especially if you're not tracking it through a separate bank account, that you have a spreadsheet. If you're a client of Wegner's, you can reach out to your contact here at Wegner, and we have put a pretty basic tracking spreadsheet together. There is potential that the SBA will also release a tracking spreadsheet. Again, we're still waiting there, but just the more documentation, the better. If you're using an accounting software and you have classes or departments and you're using it for funds that don't need to be tagged to another class or department, you can set up a class or department to track and tag those funds. But again, you have to be thinking in terms of the eligible payroll costs. It's gross salary. It's not the money out the door. So you need to be sure that you're tracking it correctly.
This is interesting. 2 recent questions have come in on the 8-week period that you and I discussed this morning. If I back up 8 weeks from June 30th, if I don't get my money by May 5th, I don't have. Now what?
That's a great question. So the reality is you are eligible to apply for the loan up through June 30th. So we all know that the likelihood is the money is going to be gone. The second round of funding is going to be gone long before June 30th hits. But there isn't anything that says the 8-week period can't go beyond June 30th if you don't get the money until, let's say, May 15th. Now, the likelihood of not getting your money until May 15th, again, is likely not going to happen because we expect that if the money hasn't actually already run out in the second round of funding, it will pretty soon. And the lenders, again, once they've approved your loan, need to pay you the money within 10 days of loan approval. So I did a little bit of looking after Melody, you and I talked before. The only date that it specifies is that the loan program is available to apply for through June 30th. But if you don't get your money until after May 5th, that 8-week period is still going to go out beyond June 30th, which is fine. The question would be the restoring your head count by June 30th. How does that play in? Well, they're probably just going to look at the average of your 8-week period at that point and ignore that June 30th date.
Awesome. I know we're getting close to time here, and one of the other things I did want to address that Kate and I talked about early on is priority of funding in terms of if you have other grants, county grants, federal grants, state grants, etc. And the clear documentation, again, as Kate has said, is it's not all defined. There are some questions that have been submitted and being asked of the AICPA specifically around how these funds are going to be treated from an audit perspective and some of the cross-funding. But what is very clear is that you can't double dip. So if you are specifically putting payroll costs for a grant contract that covers those payroll costs, you cannot then use them for forgiveness as well. If the grant allows you some flexibility in terms of timing of the payroll or what costs other than payroll are covered, that shifting around the funding is fine if it meets the parameters within the grant. But you can't apply for forgiveness and use the grant for the same payroll expenses. Anything you want to expand on there, Kate?
No, I think you covered it pretty well there. I think the key with everything that's available right now, whether it's the EIDL loan or the PPP funds or the employee retention credit or funding that you're continuing to get from your grantors or your contracts, the key is you can't double dip. You can't double dip or triple dip. There are benefits to each pot of money. And so you want to make sure that you're taking a look at what you're getting and how you use it and ensuring that you aren't crossing any lines.
So let's go back to the EIDL question too for a minute. Sure. I got the advance from EIDL after my PPP. Can I use both? Are they both eligible for forgiveness or non-repayment? How do I treat that?
Sure. So I know we didn't really have a chance to talk much about the EIDL, which we were trying to focus on the PPP in this webinar. But if you did receive an EIDL grant, so there was a grant portion of up to $10,000 that was billed as a grant only, you don't have to pay it back. And that sounds great, except if you got the PPP loan. If you got that up to $10,000 grant, which was up to $10,000 based on the number of employees you have, so it was $1,000 per employee up to $10,000. You also would have just gotten that money directly deposited into your bank account with no notification. So if you see a funny looking deposit between $1,000 and $10,000 from the Treasury, it is the EIDL grant. If you also received the PPP loan, The guidance as it stands right now is that the up to $10,000 you received will reduce the forgivable portion of your grant of the PPP loan by that amount. So essentially, it rolls into an unforgivable portion of your PPP loan. So it suddenly becomes not so much a grant anymore. Free money is never free, unfortunately. So you do need to be thinking about that. The other key piece of information that you need to be thinking about is you cannot use, if you got a loan or if you got the grant, you cannot use both of those loans for the same costs. So again, the PPP is defined for very specific eligible costs, those payroll and non-payroll costs that we went through. You can only use the PPP funding for those costs. You can't use them for anything else. If you also received an EIDL loan, you cannot use them for any of the costs that are covered under the PPP loan. The EIDL is a working capital loan, so you can use it. It's eligible to be used for a lot of other things. There is no forgivable portion in the EIDL loan. It's a 2.75% interest loan repayable over up to 30 years. So it's a pretty reasonable loan, but there is no portion of that that's forgivable. If you received the EIDL loan before you received a PPP loan, which if you're in the state of Wisconsin is highly unlikely just due to the timing of the processing. But if you did, if you're somewhere else and you got an EIDL loan prior to receiving your PPP loan, and you were using the EIDL loan for payroll costs or rent or utilities, you are actually required to refinance that portion of the EIDL into the PPP loan. So again, it goes back to actually standard SBA rules that you can take out multiple SBA-backed loans, but you cannot use them for the same purpose. That's standard if you have different kinds of SBA loans. That's how all SBA loans work. You can have multiple SBA loans, but you cannot use them for the same purpose.
Awesome. Well, I know we're coming up here to the top of the hour. And first of all, I just want to thank Kate because I know she's spent lots of hours studying all of this and getting the information. And to her point, it's changing day by day. So I've gotten into the habit of saying as of this moment because we don't know what might happen in the next. We will address the questions in the Q&A after the fact. We will look at other possibilities for future questions here and so forth. So please don't hesitate to reach out to us. Most importantly, we want to tell you that no matter where you are, we hope that you're staying safe and healthy. And we are very much wanting to support you in your organizational work and the hard stuff that's going on right now. So don't hesitate to reach out to us. Emily?
Yes, thank you both so much. And just to reiterate, any questions that you didn't get answered today, please go and throw those in the Q&A. We'll be following up. Hopefully today, we have another webinar later today, if not early next week, to answer those questions for you. We know that there is so many gray areas, and we try to do our best to clear those up for you and make sure that you are getting all the resources that you need. So thank you all for joining us. Please visit our website to see our other upcoming webinars because we have a lot of really useful information. Thank you, Kate and Melody, both for your expertise. Ladies, do you have any other comments to add?
I don't think so. Just keep an eye out for final guidance. We hope that it comes soon. Keep an eye on our website because we'll try to post things as they are updated, and keep an eye out for future webinars. We hoped to have that final guidance for today's. My guess is that we may have another one of these once final guidance comes out so we can help everybody navigate when we have that actual information.
Thank you. Everybody have a great day.
Thanks. Thank you,
Thank you.
everybody.